G'day guys, welcome to the channel. My name is Tim, and on today's episode we are looking at Elliot Wave Theory and how it applies to the Dow Jones over a period of about 100 years, and how it may be indicating a potential market crash within the next decade. Okay, so let's get right into this. So what I've got here is I've started the graph here from around 1942. Okay, and I've drawn the Elliott wave, which is a 5-step process here, which is wave 1, a corrective wave 2, an impulsive wave 3, which is also the largest wave in Elliott wave theory, another corrective wave 4, and then finally the fifth wave, the fifth impulsive wave up at the end. Okay, now to show you a little bit of theory about Elliott wave in a really simple context, this is what it looks like. So you've got the 5 waves up, and then you have a corrective pattern going down, which is A, B, C. Now, typically what happens is in this 5th wave, this is when the herd, this is when the people FOMO in, this is when there's a lot of euphoria and the market can go parabolic. And typically what usually happens is we have some sort of correction here down to a similar point to where we started. So this basically gets blown apart, and then we continue the wave up and then back down again. So now we have seen that before, and if we have a look at 1929, I'll just zoom in a little bit here. That's essentially what happened. You can see that we had this big runoff, this big parabolic run up, and essentially in the last 5 years leading up to 1929, it actually increased about 320% to get to this point. So it was quite a big run up at the very end in the 1920s, and we were overextended by these amounts, and we'll come back to that a little bit later. Okay, so another interesting point actually about that time period is Elliott wave theory was invented by Ralph Nelson Elliott, and he was actually around during this period, and it was in 1935 that he identified where he believed the bottom was going to be, and the market was going to keep increasing from there. And he released a telegram at that time, and that's basically what put him on the map. And ever since then, his theory has been looked at in various markets since then. So yeah, a little bit of trivia there. Okay, so the very first thing I'd like to point out here is just how textbook this looks. Like this is actually incredible how elegant it is. Like 1966, we had the pullback. Now, if I zoom into this period, like I find this fascinating. So some people might see the price here as just, crashes and squiggles like that. But you can see how we had these lower lows until we finally had the crash the largest crash there in 1974. It was basically a straight line down. So, and that was an 8-year period. And then we had something similar in the 2000s. So we were leading up here to the dot-com bubble, and we are looking at the Dow Jones, which is not full of tech stocks, but you can see there was a parabolic run-up leading up to that 2000 period. And we had a similar situation again. So history kind of rhymed there. We had one little crash, and then we had a larger crash, which was the global financial crisis. And that was a 50% crash. So you can see there, we did have, there's a straight line between those 2 points. Okay, the other thing that was also notable is this red line is the 25-year moving average, and I noticed that's where we tend to bottom. So we ran right through it right there in 1974, and we came very close to it here in 2009. But in 1929, you can see we crashed all the way through it. So whenever you crash through a moving average like that, it's more than just a correction. You could argue that even though these were considered crashes by definition in the stock market, we still corrected back to a moving average price here. Whereas in 1929, we crashed through that, and we did an A, B, C corrective pattern before starting the Elliott wave in 1942. So I find that really, really interesting. Okay, now let's get to the top section here, which is where it gets really interesting. Now, this is a little bit of speculation about where we may end up, but I'll just show you where we are currently. So in terms of how far we're extended above the moving average, we've got a 30-month moving average, and at the moment we're 22% above that. And as you can see back here in 1929, we were 56% above. So we're we're not even halfway as extended as we were at the top. And in terms of the 25-year moving average, we're currently 141%, and back in 1929 we were 285. So you could almost argue we're somewhere roughly halfway. Okay, so what I did is I measured another 5 years from where we are. That brings us to 2026. And in order to get to those same levels, we only have to increase in price by about something like 90%, which is a lot. That is a lot. But in the 5 years leading up to the crash in 1929, it went up 320%. So it's not asking a lot to increase by that much. So the question might be then, what could cause us to go up 90% in the next 5 years? That's a pretty significant increase. If you've got money in the stock market, going up 90% in 3 years is a pretty big deal. So there are a couple of factors that I'd like to draw your attention to. One is the money supply. What we're looking at here is the M2 money supply. And this is from 1985 up until the current date in 2021. And you can see during the GFC, there was an increase of about 8.5% of the money printed and so forth. And now, since COVID, we've had unprecedented levels of increase, and now the level has increased by 32%. That is a crazy amount of money to enter the system in such a short period of time. And you can see that all through this last 40, almost 40 years or so, it's been a fairly steady increase. So this is parabolic. Now, that has been offset somewhat by productivity. So during the COVID crash, businesses are closed and there is less productivity going on. What we're looking at here is the gross domestic product for the USA, and you can see there was a 10% drop during COVID, but now it's bounced back. It's bounced back about 13%, and we're not quite at the same trajectory that we were at, but we are getting very close. So it begs the question, once businesses reopen and get back on track, and we have an extra 32% of money in the system, what impact will that have on the stock market? So that's an interesting question. Another thing I'd like to draw your attention to that could potentially provide us some more insight of why we might actually have a crash and not just correct to a moving average. You can see here over the space of from 1974 to 2009, we did come back to that 25-year moving average. So this is something that we are coming back to on a regular basis. In fact, we came back to it there. So you can see every 30 years or so, something like that, we do come back. We do come back to that moving average. So it could be a little bit early to do that, but if we start going parabolic, that's where we need to be a little bit on edge. Now, let's have a look at the debt levels, and this could be another factor that plays into why we might have a deleveraging event. So here we have the US debt levels from 1950 right up until the current day. So you can see, once again, we've kind of gone parabolic, and we're right now at about $28 trillion in the US. And we can compare that to other countries as well. So you've got the US at 28, China about 8, Japan is close to 15. And then if you look at Australia, we're about $700 billion in debt. And you can see in comparison, we've got the GDP next to it as well. So there's a lot of factors that we have to think about. Those are some of the factors. So in a nutshell, that's how the Elliot Wave Theory is looking, and it just looks so textbook, to be honest. It just looks like this, could happen. If we did drop, let's say in 2026, so 5 years' time, let's say we get up to those same levels that we were seeing in 1929, and we did drop 89%, which is what we dropped back then, that would bring us back down to exactly pretty much the GFC levels back in 2009. So that would be catastrophic. Now, some people might say, yeah, but it's different now. But that's been said all throughout history, and that's always led to people eating their words. So, Anyway, that's all I'd like to say for today's video. Anything can happen. There's no guarantee this will happen. This is speculation. Uh, you know, if hopefully it does not happen. This would have a major effect on the world. But at this stage, this textbook Elliot Wave Theory is in play, it seems. So let's see what happens over the coming years. If we notice euphoria in the streets, if we notice everyone is getting onto the stock market, everyone's making money, easy money is occurring, there's world's tallest buildings being built. But if all these types of things are all happening, it could be a sign of a crash, and it will be when people don't expect it, when there's complacency, when people are throwing money into the stock market, people are speculating, and prices are going up really fast and sharply. So that's what we need to look for. So anyway, until the next video, I hope you enjoy that. Again, this is not financial advice. It's purely entertainment value, but everything I'm showing you here is real data, except for this section here, which is the speculative part and also the scary part. So until next time, I hope you enjoyed that. I'm Tim, and cheers.